Hello there, this is John with Gringo.dev, reporting live from Mexico City, Mexico. But yeah, today I wanted to talk about Planetscale and what's going on over there. Like the very brief summary for anybody who's not aware is that the free plan is no more. Basically, what you're getting for free now costs $39 a month. And some folks have been laid off from sales and marketing in the company, primarily including some people that I follow pretty closely on YouTube, like Aaron Francis and some others. So bad news, I guess, on all fronts. But what I thought I'd do is, just cast kind of a critical eye, informed by my experience as an early employee at different startups in Silicon Valley, an investor, a founder, former CEO, et cetera, and just see if we can make sense of, what goes on here. I think it's a good exercise for everybody to kind of put themselves in the shoes of a hypothetical CEO and see how you would handle situations, or if you can understand why they're making the decisions that they make. So I'll also preface this by saying that I don't actually know anything. I don't personally know anybody at Planetscale that I know of. I have no inside information. So this is all just based on my experiences at previous companies and then what I could figure out publicly. But anyway, let's start with a little bit of math. So when you're running a company, you want to understand what your runway is. Basically, how much time do you have to operate before you run out of funds, right? And so if you look at Planetscale, they last raised $50 million towards the end of 2021. So we're a little more than 2 years after that. And they may have had some extra cash in the bank from previous rounds, et cetera. So it's not that their entire bank account was 50 million, but that's the last raise that they did, at least that I can find. And also on LinkedIn, they have somewhere between 51 and 250 employees, perhaps less after the layoffs, but I'm not exactly sure what that count is, but we can say that it's something like 100 employees total. And if you assume that those employees are making something like $250,000 a year on average, which I don't think these are crazy numbers, especially given that a large part of the headcount is going to be in the Bay Area. You're talking $25 million a year in headcount expense. So that is kind of interesting. So $25 million times 2 years roughly gets you to just about $50 million. So like I said, I'm not saying that Planetscale is out of money, but my guess is that they are kind of getting to the point where they have to start thinking about how much time do we really have left. And so, of course, your burn, like the amount of money you're losing, is a really critical ingredient in that. And my guess is that maybe they have been thinking about this for a while. I think about 2 years out from being dry, um, you know, you start thinking about that stuff. Do we need to raise again? Something like that. Maybe even 3 years. But it's usually around the 1 year mark from being done that you really start, okay, we need to laser focus on what do we have to do to get to, if not profitability, at least sustainability. And sometimes that means just getting to a bridge round, like a smaller raise or whatever. So I don't know exactly what Planetscale is aiming for right now. They say profitability. It could actually just be that they want to get their financials good enough to raise again and get a longer runway. All of that is possible. But the other complication here is that the fundraising environment is terrible. So not only is it difficult to raise money, if you do, it's probably going to be on brutal terms. When I say terms, I mean things like liquidation preferences and stuff like that. And so, yeah, it's if you know that you're going to have to raise again, it's in your interest to make the financials as strong as you possibly can, in sort of like an accounting sense. And ideally, you just don't even have to raise at all. That's what profitability would get you inherently. So all of that kind of makes sense on the surface. And I guess the takeaway would just be that at a very high level, my guess is that their bank account was getting low enough that they had to start thinking about how they were going to continue, even if they weren't out of money yet. Um, so moving on to the free tier side of this, or I guess the death of the free tier, um, we can think through this using a similar lens. So, let's just take the blog post at face value, and let's assume that if every customer starts paying $39 a month for what used to be free, they can now become a profitable company. So that would imply that $39 is essentially the real cost of supporting every real database, maybe plus a little bit of gross margin. So that's interesting in and of itself. So you can kind of think of that as a bound on how much it costs to really operate this software in all senses, right? But what's also interesting is just intuitively some of these things uh, do scale with the size of the customer, and some of them don't. So for example, like as a customer gets bigger, they're going to need more compute, more memory, more storage, more everything in sort of a technological sense. Um, but probably like their support cost doesn't necessarily go up. There's probably like a step function increase where they go from not needing a sales rep to needing a full-time sales rep. And, of course, that's going to be a new expense. But then after that, it more or less, just stays constant, right? And meanwhile, on the other end of that spectrum, you might have free plans that are being supported by email, chat, things like that. I'm not exactly sure, but the point being that even if somebody is a free customer, they're still costing money to the company, and they're not even just costing money in the sense of like compute and memory, which is going to be small anyway. They're costing money in terms of the time of employees, um, both in the sense of marketing needed to target them, the time that it takes for that marketing person to figure out how to reach these smaller fish, and then also the cost of marketing through the channels as well, which is not cheap, right? And so probably when you net all of that out, the true cost of a free database was something like they are charging you now on what was formerly the free plan. So that's interesting in and of itself. I also just think it intuitively jives with a lot of my experience, where I think that it's kind of hard to find a polite way to say this, right? But you just look at open source projects, and that's a case where, at one end of the spectrum, it's literally free. So, the maintainer is giving away the software, giving away the code, a lot of times doing support and stuff on GitHub, essentially for free. And then, people are just very abusive, sometimes even, and very demanding and whatever. And so there is kind of a pattern I've noticed where, you would think that the more money at stake, the more demanding the customer is going to be. Oftentimes it's exactly the opposite. And this is a good lesson to keep in mind when you're building your own business. But a lot of times the people who are consuming stuff for free are the ones who expect the most out of you and have the highest expectations for instantaneous support and all of the rest. And so there was a similar situation in my past. I was working for well, I won't give the name, but I was working for a large robo advisor, one of the first. And at the time, the minimum investment amount was $5,000. And the theory was, hey, look, if we lower $5,000 to something more manageable, then maybe we can get these younger investors when they're just starting out and like their accounts will grow a bunch over time, and it's going to be great. And so we did a bunch of work. I was actually the product lead on all of the investment tech, and so we did a bunch of work on lowering that minimum with some pretty interesting stuff that we did, but neither here nor there. So after a long period of time and a lot of data, it was interesting to see that the conclusion was, on the contrary, that lifetime value decreased. And what I think happened there was people were anchored at a relatively high amount of money before, and that tended to cause them to value the service more. And so when it took less money to get in, it may have been perceived as either a little bit less exclusive or a little bit less valuable. And for that reason, probably among others, we ended up decreasing the average size of the account. Now, I think the company was still happy with the product overall because it was good for brand reasons, and at least their secondary theory was that all of these people that we get on the platform are sort of performing free marketing for us or something. I left before any of that could pan out, so I'm not exactly sure. But in any case, it was interesting to note that bringing in more people ultimately decreased the value of the product. And then also those same people, they still needed to be supported, right? And a lot of times people who are investing their only $500 into a product care more than a multimillionaire who's throwing $100,000 into an account just to see how it performs and check it out, right? And so weirdly, the biggest fish oftentimes ended up being the lowest maintenance, and vice versa. So I do wonder if there may have been a similar, dynamic at play here for Planetscale too. But the other side of this too is the layoffs. And before anything, I'm just so sorry to all the people who were affected. And I know for a fact some of them were like very good just from watching what they do on YouTube and other places. But um, yeah, this is probably one of those out of necessity things, is my guess. And yeah, it's like headcount is almost always your longest lever to reduce burn. Again, if you assume every employee is costing you, 250K to the bottom line, then, that's one of those things you probably don't want to do it, but you have to evaluate what kind of strategy, what kind of strategic changes do we want to make? And I'll come back to that in a second, in order to help the company survive. And then after that, what functions or people are no longer in alignment with that. And yeah, I think ideally, you see this happen all the time where, a project doesn't work the way people hoped, or it's no longer kind of with the program, so to speak. And if it's engineering, you can move people around, ideally, right? And so maybe you can find a place for them on another team where that bet happened to pan out and is making a bunch of money and they need headcount, right? For some functions, that's less doable, right? So, what I think is happening here, sort of in a broader sense, is that we're probably witnessing Planetscale pivot away from supporting like small, let's call it hobby developers and databases, and attempting to get more into the enterprise market. And so one of the dynamics of enterprise versus mass market, marketing tends to be much more important at the low end. And so, whether it's Google Ads or participating on Hacker News, producing YouTube videos, like whatever it is, marketing is sort of your substitute for not having a dedicated sales rep to reach people in a lot of cases. If somebody is huge and they're on MySQL and they aren't yet using Vitess, I have to imagine that Planetscale is willing to get a big sales rep and like try to pursue them and like all of these things, right? Um, but yeah, it's hard to justify that for somebody who, is averse to paying $39 a month for a database, right? Anyway, all of this to say that I think Vitess, which is the technology underneath Planetscale, starts to get most valuable at the very high end. And what I mean by that is when you need to start sharding your data, typically by row, or by tenant, whatever, that's when Vitesse is going to like really, really shine. And so, and that's also one of the things that like kind of hard to set up yourself. I mean, maybe you could hire somebody who understands Kubernetes and, set up a control plane and like do all this stuff to get Vitesse running. But, at that point, spending, I think the minimum was 36K to get sharding with Planetscale. So it's like, okay, do I want to hire my own database guy for 200 plus a year? Or do I just want to play 36 to Planetscale and have them essentially do it for me with a lot of other goodies too? So even me, like I actually like Planetscale a lot. I'm a fan of the company, but even me kind of like thinking through the life cycle, I'm like, well, really where things get most interesting to me with respect to Planetscale is actually at the very high end. And, I start comparing the cost of that product against what it would cost, you know, what I no longer feel comfortable doing myself, which is probably operating of a test cluster. And I would probably conclude as a business owner that it's a good idea to move over. And so my guess is that Planetscale kind of went through that exercise, like just sort of learned from their customers, both in terms of how they perform economically, but also like where those customers are getting the most value, and just decided that the higher end of the scale is where they wanted to specialize. And, I actually think that's a very defensible strategy. It does kind of suck that some people got lost along the way. And unfortunately, it seems like it always feels like a out of nowhere kind of thing because it's just the nature of, I guess, personnel deliberations that you don't want to tip your hand until you actually understand what you're going to do. It's kind of like a breakup in that regard, like you don't want to just sort of muse out loud, like, huh, maybe we need to break up because we're not compatible. Like you actually need to have that decision kind of made. And then importantly, this is where people mess up. You need to stick to it, right? I mean, in sort of a personal sense, they mess up. But yeah, I think layoffs are kind of similar in that sense, where it's you almost can't talk about it beforehand because then that's going to lead to the end of the work relationship. And then once the decision is made, you just almost need to get it over with quickly for a variety of reasons. So yeah, sucks for everybody, especially the people who got laid off. And again, I'm sorry to everybody that that happened to. But yeah, so that's kind of my analysis on the situation. So just to recap, I suspect that the company is probably not out of money, but just getting to the stage where they have to start thinking about it. They realized that the free tier was never going to perform for them economically, and therefore they cut it. Um, and I think that's both for just very straightforward economic reasons, and then also just like some psychographic reasons within the type of customer that's willing or not willing to pay. And then I think the layoffs were just sort of a consequence of, look, if we're going to focus on a certain point of the spectrum, certain things like marketing become less important for reaching the type of customer that we want to reach. So that's my take on things. Again, I have no inside info. This is just sort of speculation on my part, having seen some stuff and then just reading what I can find publicly. Um, but I hope that was useful. And again, I kind of encourage people, like if you eventually think that you want to be in a leadership role at a startup, these sorts of things can be great opportunities to sort of like exercise that muscle of like, well, can I analyze a situation from the outside and get a sense of what's going on? And if I were in this position, like I could be completely wrong, right? But think about it. If you were in this position, let's just say it's true, where you have a database company that's maybe like 1 year away from running out of cash. what would you do? You know, and just sort of war game some of those scenarios and everything like that. But anyway, hope that was helpful. I will be in touch with all of you soon with some more videos. Hugo and I are probably going to be recording another podcast this weekend, and I will see everybody soon. Take care.